Hello, property navigators. Check this. Australians are predicting a property market boom over the next 12 months. Westpac's monthly indicator of house price expectations just hit a 15-year high. October saw it reach a high of 172. That's up 12.2% over the past year and 34% higher than its long-run average of 129. In April 2021, when property prices were boosted by near 0% interest rates, this indicator reached a high of 164. And in the 12 months following, prices rose 16%. But that's why right now is the time to be most careful where you buy, because so many will just go out and buy anywhere. AMP's economist has literally said consumer expectations of house prices are a strong predictor of future growth. Why? Because when people think prices would go up, they are more likely to try and buy sooner rather than later. It reinforces positive sentiment and creates a feedback loop. Don't rush in and make a mistake. Today we'll cut through the noise with hard data, not hype, and lift the hood on the factors affecting our markets nationally, so you're a bit more in the know. Let's go! Macro factors. National home values have now risen for 8 months in a row after a 0.2% decline between November 2024 and January 25, which Quartiles itself called a short and shallow downturn that lasted just 3 months. September 2025 delivered the largest monthly price gain in 2 years of plus 0.8% nationally, with lower interest rates playing a central role. Market recovery started around February, roughly when interest rates began falling. The 3 rate cuts have boosted buyer demand by improving borrowing capacity, with the lower rates meaning average buyers can now borrow roughly 7% more than before the cuts. At the same time, the labour market is still tight, and real wages have been rising at the fastest pace in 5 years. And it shows. The annual volume of home sales is tracking at 2.7% higher than a year ago and 4.2% above the previous 5-year average. Housing finance data to June shows investors are also super active, accounting for around 38% of new mortgages. The RBA's credit aggregates data, new borrowing minus repayments, shows investor housing credit is growing at its fastest pace since 2015. Pretty wild. But this demand is running head-on into what Quartiles' head of research has called a supply crisis. But this isn't simply referring to Australia not building enough new homes. Everyone's banging on about that. It's speaking to the fact that there's a very scarce level of listings in the marketplace, bringing us to discuss supply. The inflow of new listings is up seasonally, but still down on the last year's average, and rapid sales are preventing any meaningful build-up of stock. Total listings are 15% below last year and 20% under the 5-year average. This pattern is nationwide. It's now rare to find any capital with listings at or above historical averages. Perth, 45% below its 5-year average. Brisbane and Adelaide both 30% below, and Melbourne was previously above its average, but stock has fallen back below as absorption has strengthened. Even with the usual spring lift in new listings, buyer absorption is so strong that total stock remains stubbornly low. Market conditions. With sales up and listings down, conditions are firmly vendor skewed. It's a seller's market. Homes are selling in about 27 days across the capitals. Vendor discounting is under 3%, near record lows, meaning little room to negotiate, and auction clearance rates are in the low 70% range on finalised results, well above the long-run average. By any measure, the market currently favours sellers over buyers. Affordability and pricing quartiles. While housing values are expected to continue rising further across most markets, housing affordability remains stretched, and this is likely to keep a lid on the actual pace of capital growth. Looking across the pricing quartiles, growth has begun to ripple down from the bottom toward the middle of the market. Over the past few years, the lower quartile led gains. More recently, the middle quartile has posted the strongest unit growth, and for houses, the broad middle is catching up to the lower end. This shift likely reflects the rate cuts lifting borrowing capacity by 7%, pulling more buyers into that mid-price bracket. Even so, the most affordable segment still attracts the deepest demand. Now let's cover off our capital city markets, which are all now rising in value. Darwin is clearly running its own race, with values moving with pace up there, mainly due to its affordability. But even across the more mid to large size capitals like Brisbane and Perth, there's a re-emergence of diversity, with values rising at more than 3.5% quarter on quarter after slowing down at the end of last year and even dipping into some shallow negative movements. Some of the softer markets like Hobart and Melbourne have moved back into a level of growth. Hobart is still the weaker market but is edging back, and Melbourne has seen housing values trending positive since February, and its annual rate of growth has come back into positive territory. Capital growth rates. You can see the diversity of our capitals most clearly over the past 5-year growth figures. The mid-sized capitals have performed awesome, each up 77% or more, adding roughly $430,000 to Brisbane's median, and even more in Perth in terms of percentage growth. At the other end, Melbourne has risen 17.5% over the same 5-year period. Melbourne's underperformance reflects several headwinds: deeper pandemic disruption, a sharp rise in state debt, and tax settings that deterred investors, most notably the cut in Victoria's land tax threshold to $50,000. The rates of land tax aren't necessarily higher, but the much lower threshold captures far more investors, acting at a surface level as a disincentive. The flip side is a clear affordability edge. The price gap between Melbourne and Sydney is at its widest since about 1999, which should gradually attract more buyer demand despite the tax environment. We've already seen more positive commentary and early signs of improving investor appetite. While annual rolling growth rates have been converging across cities, the latest quarterly results are diverging again, suggesting annual trends are likely to spread out once more. Suburbs where dwelling values are below their peak. The market's renewed upswing means far fewer suburbs are below their previous peaks. Today, about 5% of Australian suburbs sit 10% or more under their record highs, down from roughly 10% a year ago. Around 58% of suburbs are now at all-time highs. The picture varies by region. In Perth, almost every suburb is at a new peak, while regional Tasmania, and to the lesser extent Melbourne, has a larger share still below prior highs. At the city level, Melbourne remains about 2.5% shy of a new record. Hobart is roughly 9.5% below its March 2022 peak, and Canberra is also slightly under its high. Across most capitals, detached houses are still outperforming apartments despite stretched affordability and limited new unit supply. The key exception is Brisbane, where units have consistently outpaced houses. Brizzy's post-2019 apartment oversupply has all been absorbed, and unit listings are roughly 50% below their 5-year average, and we are seeing that affordability pressures are nudging buyers towards apartments in this market. A similar, though less consistent pattern has appeared in Perth and until recently Adelaide. By contrast, even in expensive Sydney, house values are still rising faster than unit values. This is happening alongside a record house unit price gap. In Sydney, the median house is about 76% more expensive than the median unit. Brisbane's gap peaked near 80% in early 2022, but has halved to 40% as units have outperformed and house prices corrected during rate rises. Looking ahead, affordability will steer some demand to townhouses and low-density units as the next best option, but Australians' preference for space means detached homes remain the preferred choice. Moving on to regional Australia, which of course deserves its own analysis too, because the tables have now turned. Again, for roughly the past 18 months, the regions looked stronger, largely because the capitals lost momentum in the back half of last year. That's now flipped. Capital cities have re-accelerated and are again outpacing the regions. This doesn't mean the regions are weak, just that performance is highly uneven by location. Over the past 12 months, the standouts have been Albany in Western Australia is the national top performer with values up around 20%. Western Australia's Midwest, including Geraldton, is up around 18.5%. Mildura in Victoria is up around 18%, bucking the broader, softer trend in regional Victoria. Darling Downs in Queensland, just west of Toowoomba, is up around 16.5%. And also very notable are Townsville and Mackay in Queensland. Both are very strong at the moment. What's changed is who's leading. The top regional growth is no longer concentrated in the classic lifestyle hubs like Byron Bay, Newcastle, Geelong, Wollongong, the Gold Coast and the Sunshine Coast. Leadership has shifted further afield to more affordable, economically driven centres, often tied to resources, agribusiness, logistics or regional service hubs. These markets started from lower price bases, often have tighter for sale stock and offer stronger rental yields, so even modest demand can translate into outsized price gains. Now, as I've already mentioned, the volume of home sales nationally is up, but let's quickly look at individual state data. Most markets are running above their 5-year norms. Where they're not, the shortfall is modest. One outlier is Darwin with an extraordinary 75% increase. Pockets of softness are evident in regional Tasmania and regional South Australia, in some cases coming off a high base. And lastly, it wouldn't be right if I wasn't to cover the Australian government's 5% deposit scheme. This is a hot topic right now. The expanded deposit guarantee went live on 1st of October. So now first home buyers just need a 5% deposit, with the government guaranteeing the difference between that and the 20% deposit needed. Borrowers then avoid paying LMI, saving them tens of thousands of dollars. The changes in plain English mean access is wider, there is no income caps and no limit on places, and the price caps are also higher. Sydney now has a $1.5 million cap, Brisbane $1 million, Melbourne $950,000, and so on. So what does that mean in the market? Right, to start with, this doesn't mean anyone that wants to buy their first home can just go out and buy at the price cap limit. Absolutely not. That belief has let a lot of panic creep into people's minds. The big handbrake is still serviceability. Many first home buyers will qualify on deposit, but not on monthly repayments. That's the crux of it. Nonetheless, a burst of buyer activity is expected, especially right under the cap limits, which are set roughly in line with the median house value across most regions. That said, it could be short-lived in popular pockets as prices push past those caps. Nationally, 50% of suburbs have a median house price equal to or lower than the new price caps, while 93% of suburbs have a median unit value equal to or below them. Check out these maps to see what this looks like at a suburb level. Brisbane has 43% of suburbs where median house values are below the $1 million cap, while 94% of suburbs had a median unit price under it. Melbourne, well, 42% of its suburbs qualify for houses and 94% of its suburbs for units. And 48% of Sydney's suburbs have a median house value below its price cap and 93% of suburbs for units. Really valuable info here to provide some context around the scheme. So what does this all mean? It means don't panic. We're not running out of houses to buy, even though stock is a bit skint. It means don't just go out and buy anywhere, because that could probably turn out to be worse than buying nothing at all. It means don't just go out and buy any investment type to fill the property investment void. If you need a hand, even just a chat to understand what's happening in our national markets, then just give Boyd and I a call. Everyone gets a free discovery session, and we can help you with this and any other questions you may have. And remember, what happens in Australia's property market affects everyone, not just homeowners. Our residential real estate market is valued at nearly $12 trillion, around 3.2 times the entire Australian share market size, and about 2.7 times the value of all superannuation funds. And if you combine the value of all of Australia's super funds, stock market, and commercial real estate, it doesn't even come close to the $12 trillion our residential market is valued at. So stay informed and on top of the market before making any high-value decisions. Until next time, happy property navigating.